Howdy, Jacob here. Today we're looking at Ethan Allen Interiors. All right, so 4.85% dividend yield, $754 million market cap, $591 million enterprise value. So good, solid, some solid net, uh, more cash on hand than debt, which is good. Um, Looks like they're entirely cash free, or sorry, entirely debt free, just 105 million in capital leases. So that's good for them. As for revenue, looks like a very flat business. 747 10 years ago and now 791 million in revenue. But on the return on invested capital side, so when it comes to comparing their earnings to how much it takes to invest into the business, last 3 years have looked very promising. So I guess we'll see if we think that earnings per share can last. Let's look on a cash flow basis. That 4.89% or 4.8% dividend yield is paying out a little over $40 million. Looks like the last 3 years they can definitely afford that. 2020 and prior, that might be a little bit more payout than what they'd want, but they do have 173 million in cash and cash equivalent with short-term investments included and no debt. So it might be a company that I think can keep that dividend where it's at based on based on both their payout and the healthiness of their balance sheet. So I think first assumption we can make is that $1.44, let's keep it there. I wouldn't say that their earnings are increasing consistently enough to increase that dividend, but I think we can say that as of right now, that $1.44, 4.8% yield is pretty reasonable. On the cash revenue basis, I might just assume 0%, just because the last 10 years hasn't really done anything. And then I'll just do 10 on the PE side. I was considering going higher, but the last 3 years ROIC isn't necessarily what it was looking like prior to that. And so I'm just assuming that they'll probably meet, somewhere in the middle, maybe 9%, which is pretty market average. I don't see a reason to inflate any P or price free cash flow based on the return they get from investing into the business. And again, their payout is pretty high. So, recently they've been doing a lot of investments, so we'll see how those pan out. But if this what appears to be inflated excess free cash flow doesn't hold and they get back to pre-COVID figures, that payout is pretty large, so they just don't have as much money to reinvest back into themselves at the rate of return that looks pretty grand right now. As for margin, we'll do 6 and 8. We'll assume no share changes. Yeah, okay. It's not looking crazy pretty. It looks like it currently has to drop 55% to get us to a 15% return, but this could be a business that someone else knows about. Maybe this 0% and 10 on P price free cash flow is reasonable. But as for the dividend yield screener itself, I think that this company can hold um, its dividend, which would be a very solid yield for someone who just wants excess free cash flow or is in retirement and wants to just make cash off their investments. And so they could be an interesting company to put on your list. But for now, I'm definitely just sitting on my hands waiting for it to go a little lower to do a little more research. So thank you and hope you have a good rest of your day.